Good morning, everyone. It is so nice to have you all join us today for our annual investment update. I know this is an event that our stakeholders really look forward to every year, and being able to hear from our investment committee and our partners at Wells Fargo. So just really pleased that we're able to do that again this morning. Just a couple of things before we get started. The chat feature has been disabled for the webinar, but if you have any questions that come up throughout the discussion, please use the Q&A feature at the bottom of your screen, and we will respond to those questions as we can during the event. If there's something we don't get to, we'll be sure to follow up with you afterwards. And then the second thing is there's a really quick survey that you will see come up at the very end of the webinar after it closes. If you could take just a minute and fill out that, I promise it will only take you a minute, and we're just looking for some feedback from you all. And so I hope that will be a way to get that. So with that, I'm going to turn this over to Kristina and the investment committee and let them take it from here.
Good morning, everyone. You know, it's in the age of COVID, sometimes these feel like they've happened right back to back. And on the other hand, the last time we spoke to you also seems like it was a very, very long time ago. But we really appreciate everyone joining us today. It's a distinct honor of mine that I currently serve as chair of the investment committee for the Community Foundation. It's something that speaks to me. I went to UVA a long time ago and felt connected to the Charlottesville community when I was here. So this is a really lovely development in my professional life that I can serve the community in this way. I am joined by several other members of the investment committee, and I think that it makes sense just to kind of start off. I know that a lot of you have seen us many times, but it's always good to kind of remind everybody of who we are and more specifically why we're here. So Alice, as a tenured member of the investment committee, can you please tell us about your background and what brings you to the CACF?
Sure. Can you hear me? Okay. I was approached. I had just started Investure back in 2003, and the then chair of the investment committee, or the CFO at the Community Foundation, came by and said, "Would you join this?" And since this was going to be my business, I figured I might as well figure out what was going on. So I joined and stayed ever since. It was very small at the time. It was managed by, I can't even remember, First National Bank or something or other, of Roanoke. And we had a very, very basic portfolio and grew from there, which was really pretty exciting. I said one of the very early investment, but we knew we wanted to have something that was different from what everybody else had. And so that's my background. So 28 years at the University of Virginia and 15 at Investure, and I'm retired now to CACF.
Fred?
Yeah, good morning, everyone. So I grew up in Virginia and went to UVA, and that was my first kind of intro to Charlottesville, although I do have some family here, or did have some family here. I spent a few years in New York after college, and then back to Virginia, where I've spent the last 15 or so years in the institutional investing world, first for some high net worth families, and then the last six years at Investure. So a few years ago, I was starting to think about, hey, I've been in Charlottesville a while, settled in, would like to get involved in the community in some manner. And Alice, who kind of has a sixth sense for these things, just coincidentally approached me right around that time and said, hey, would you have interest in joining this CACF investment committee? And so I joined for a couple of the meetings and really enjoyed it, really enjoyed the team and the mission. And so fortunately I've now been a member for about a year and a half now. And my background is more in the investment world. So, serving on the investment committee, I'm able to hopefully help about the investment portfolio.
And Kristen.
Good morning, everyone. So Kristin Henningsen, I'm Managing Director of Investment Operations at CornerStone Partners. And a little bit about my background. I've led the operations team at CornerStone now for nearly 10 years. CornerStone is an outsourced chief investment office located here in Charlottesville, and we manage approximately $10 billion in assets exclusively for nonprofit clients across the U.S. As leader of the operations team, I'm responsible for overseeing client services such as performance reporting, portfolio administration, custodian management, audit and tax support, among other areas. Prior to CornerStone, I was in public accounting for well over a decade and continue to be an active CPA. Prior to public accounting, I worked for Payne Weber in the area of SEC reporting for several years. So regarding my role on the investment committee, I bring a slightly different perspective with my operations and CPA background, perhaps with an additional focus on governance and compliance. And in addition to the investment committee, I'm also a member of the governing board and executive committee. So I guess a little bit about how I found my way onto the investment committee. I've been serving on the committee for 2.5 years now. And I was first introduced to Brennan and her team by a former investment committee member and CornerStone founder, Don Lang. And my experience working with the foundation has turned into one of the most enjoyable extracurricular activities of my career. So thank you, Don, if you're out there and you're listening. So these have been very difficult times for many, and I've just been in awe of the unbelievable work that's been done by the foundation. Not only their day-to-day grant making, but also the tremendous COVID response and the more recent collaboration to end homelessness, which is a community effort that will drastically change the lives of our homeless and poverty-stricken population. So to the donors out there and the foundation team, thank you very much for the opportunity to be here today.
And as I said before, my name is Kristina Koutrakos, and I am currently the Director of Portfolio Strategy for the Virginia Retirement System. After UVA, I ended up going into fixed income portfolio management. I worked at Western Asset Management and then at BlackRock in New York. And then after the financial crisis, I actually switched tasks and started a consulting business, began working with some family offices, and ended up over time finding my way back to Virginia, which has been lovely. Many of you have been with the foundation for a very long time, but one of the things that we like to do is to level set for the newer additions in the group in terms of how this committee functions and the ways that the portfolios are managed. And for the purposes of this discussion, we're actually going to focus on the long-term portfolio that houses the majority of the foundation's assets. So I think it probably makes sense to start with Kristen. So she says, she brings this operational and compliance perspective. I think that downplays her role pretty significantly, particularly given the focus that she has in really ensuring that the foundation has a strong governance structure. So Kristen, can you talk a bit about the role of the investment committee and how we work both with the board and the foundation teams, given that you have a really strong position within the board as well?
Sure. So the governing board is ultimately responsible for appointing the investment committee members and selecting the chairperson. We are very blessed to have the unbelievably talented Kristina Koutrakos leading the committee today. So all the foundation committees operate under a board-approved formal charge. Our investment committee current charge includes items that you'd expect, such as maintaining the formal IPS, setting asset allocation targets and ranges, meeting to review portfolio activity and quarterly returns, selecting and monitoring investment managers. However, we did add new language this year to include a charge to explore opportunities to align investments with the foundation's equity commitment and values. So the investment committee also has a board-approved annual work plan that outlines the content and timing of our work for the year. And also new this year, similar to our charge, it includes investigating various approaches to impact and values investing. And we'll talk about that a little more later in the program. The investment committee meets at least quarterly, Zoom over the past year to review investments and meet with Jim Beckett and his team from Wells Fargo. So in addition to the investment committee, Brennan and Murray, our new director of finance, Andrew, our controller, and Andy, the operations coordinator, also attend these meetings. Christina and I currently sit on the governing board, and along with Brennan and now Murray, we provide periodic investment updates during the quarterly board meetings.
Thank you, Kristen. Fred, can we have you talk through how we work with external managers and specifically the oversight that this committee provides when it comes to people like Jim, but also Agincourt and Bluestem and some of the other managers in the portfolio?
Yeah, sure. So, as Kristina mentioned, there's several pools: the long-term pool, short-term pool, and then some separately advised funds. And we'll generally be mostly talking about the long-term pool in this call, but all the assets in all of those underlying entities are generally invested in third-party managers, external investment managers. And as such, we try to oversee all those managers. I split it into a few groups. So a large bulk of the portfolios are in just what I would call kind of plain vanilla equity managers. And Wells Fargo oversees that. And so we work with Jim and his team on that. And that's primarily mutual funds. So there's great transparency there. And in access. The other groups are just fixed income, and so that's a group Agincourt based in Richmond, and then alternatives, which is managed by Bluestem right here in Charlottesville. And we monitor the performance and quarterly letters and updates and things like that on a monthly and quarterly basis, and so that's sort of a frequent occurrence. And then at least annually we meet with the teams, or at least a subset of us meet with the teams and get sort of more detailed updates. A couple of things I'd say. Many of us on the investment committee, as you heard from our bios, are involved in this world day to day. And so we're also selecting managers and looking for investment opportunities. And so I think, we can take some of that, our daily jobs, and bring it into this, into this experience as well. The one other thing I would say specific to this is that it's a relatively small universe, and especially in the Virginia investing community. And so some of these relationships like Agincourt and Bluestem and others go back, 10 plus years. And so many people here on the team have known these firms for a very, very long time.
So Alice, can you give a sense of the actual investment philosophy, the overview of how we think about asset allocation and how we manage the portfolio? I think that there should be
I got it now.
for finding the mute button the fastest.
I'm sure. Everything is at speed in my life. When we started out, we were a very, very plain vanilla portfolio, and then saw opportunities to be exceptional. And we figured if we were going to offer something to the community, we needed to have something exceptional in there. Bluestem was our first foray into that, and that was actually really early on into the investment process. I think that the idea is to grow the assets over time, treat it like it's an investment. So level spending rate and focus on growth over long periods of time. So it was a very, very basic portfolio. When we got here, as I said, we added Bluestem right away in the beginning because Michael was just starting out and it was an opportunity to get in. And I had worked with him at UVA and before that when he was at Tiger. And I think that, we'll talk about it later, but it's a real mistake to think about him as a hedge fund. He's not really a hedge fund. He's really more a manager of managers. So he has a lot of various different managers within his portfolio. So think of it more like something UVA would do as opposed to a hedge fund. But we'll talk, as I said, we'll talk more about that later. But the idea is to provide exceptional returns and be a valuable service to the community as we think about it. So as Fred said, we have to keep tabs on the managers. We have to talk to them and be sure that they understand, the purpose of our particular portfolio and why we're doing what we're doing. But I think that, otherwise it's we have to be exceptional or you won't want us to run your money for you.
Well, 2020 was certainly an exceptional year. It's pretty incredible to kind of look back in the rearview mirror and to think about how extreme the downturn was last year. In many cases, it was even more extreme than the financial crisis, but it happened in 6 weeks as opposed to over this period of almost 2 years. When we last spoke to you, we were talking about the rebound that was occurring both within the financial markets and within the overall economy. And that was something that was absolutely unprecedented in terms of its speed. Jim's going to talk in great detail about the actual portfolio and what we saw in 2020 in terms of our investment returns overall. But it's been a constant conversation, I think, with a number of donors, and Alice already touched on this. What is Bluestem and what's the role that it plays within the portfolio? It bears highlighting that this is actually fulfilling a multifaceted role, both within the alternative investment complex. They have private market experience, as well as a number of other approaches in the managers that they're working with. But Fred, you're the one that actually is the closest in terms of your monitoring of Bluestem. Would you mind discussing their performance last year, and particularly kind of what that role that it plays and how you think about it in terms of portfolio construction?
Sure. So as I mentioned earlier, for context, the bulk of the assets are in stocks and bonds, sort of conventional assets that we often hear about in the news and whatnot. But what Bluestem provides is the portfolio's quote unquote alternatives allocation. And that it's a little over 20% right now. And that, within that are things like hedge funds, private equity funds, maybe even some venture capital type investments, co-investments, and even alternative betas, things like insurance and other types of investments. I really think, at least the way I think about Bluestem is just really an opportunistic investor looking globally all around the world for the best investments, whatever form they might be in. And so there's a lot more flexibility than sort of just conventional stocks and bonds. And the role, it's the role within the overall CACF portfolio is really a couple of things, I would say. First, it adds diversification. And then second, it really provides a number of new return drivers that we just otherwise wouldn't have exposure to. And, last year was a prime exhibit of that very thing, where Bluestem was up 70% net. So that's net of all fees. And, that's just an extraordinary return, especially in a challenging year for the overall economy. And that was really driven by things that we would have otherwise not had any exposure to, primarily in the private, some investments in the private technology sector, things like Snowflake and some other things you might have heard about. And so it's just really, it's an extraordinary outcome. We're very grateful to Michael Bills and his team. These are things, the way the investment world works, as many of you know, is that you really sort of plant seeds years ago that sprout, on an unknown time. And some of those just happened to kind of sprout last year. And so these are the types of things that Michael and his team have been working on for years and building relationships and access to some of these investments. And we fortunately benefited from that last year. The other thing I'd say it's really a testament to a couple of things. One is just having that alternatives allocation in the portfolio, and also just having the long-term patient approach. Alternatives, like any asset class, kind of go in and out of favor, or any asset class or style or strategy. I would really call it more of a strategy than an asset class, but they go in and out of favor over time. And so sometimes it's easy to question why to have this, but clearly it's been extremely additive to the overall portfolio over the years. And again, that patience has paid off. The one other thing I would mention is, there's this ongoing debate that's been going for decades of sort of active and passive management. And the CACF portfolio is very heavily in the active management, very heavily exposed to active management, which has done great over, the portfolio has exceeded benchmarks on a 1, 3, 5, and 10-year basis. And driven by the active management and underlying manager selection of Wells Fargo and of Bluestem and the bond selection of Agincourt. And so it doesn't mean we're opposed to passive. We're not at all. In fact, we'll likely incorporate more passive over time. But I mean, I think it's just a real testament to the value of having active management, in the portfolio. And so, again, it was a great year. We shouldn't extrapolate that, but we're just really grateful to Michael and his team for the performance they generated last year and really since inception.
One of the questions that has come in was, how should we think about the maximum allocation to Bluestem, and how do we view Keyman Risk? You've known Michael for a long time. How do you think that his approach compares to kind of alternative investment kind of broad field? And do you have any concerns when it comes to Keyman Risk or concentration with Bluestem?
No, I don't, because what will happen is he will just liquidate the fund. And that's fine. I think we've gotten access to it while we have it. And I mean, he's not getting any younger. He's still a lot younger than I am, but he's not young. And at some point, he manages all his own money. And that may be what he decides to do, is to not keep managing outside money. But for right now, he's thoroughly enjoying it. It's what he does. It's his lifeblood. I mean, if you ever meet Michael, that's what he talks about. So he, I really don't have any concerns about that, because all the stuff at some point can be distributed or liquidated.
So Kristen, in your role at CornerStone, you look across private markets and see performance from all sorts of different kinds of managers. What kinds of portfolio impacts are you seeing from managers that fill this cohort?
Sure. So I guess to give some perspective as it relates to the foundation portfolio, just wanted to know, and Fred just mentioned this, our current allocation at the end of the year to alternatives was 24%. And this asset class includes our allocation to private markets, which is currently invested through Bluestem. So at the beginning of 2020, Bluestem's allocation to privates was about 33%, though it has since increased to about 54% at the end of the year, largely due to the growth in the Snowflake investment. Though we do expect the private allocation to normalize back to about 30% after the Snowflake distribution. So with the long-term pool allocation to non-traditional assets around 24%, that means at the end of the year, the foundation's allocation to privates was about 12%, with the other allocation to hedge funds also about 12%. As Fred noted, we had a huge win in our private allocation in 2020, but that might not always be the case in a heated and rising public market, like we saw after April of this past year. And likewise, private returns also generally don't experience the same degree of losses in declining public markets. So when markets are down, private equity might go down, but hopefully not as much. Some believe private equity will outperform public markets over the next few years, and with the expected poor returns, for fixed income, I think we might start seeing institutional investors start widening their allocation to the private market space. The investment committee really takes a long-term view in our investment philosophy. Within the long-term portfolio, we expect to continue to commit to managers over the full market cycle. As such, we expect private investments will continue to be a meaningful contributor to returns, while also reducing volatility. So I was looking back at historical performance, and once again, Fred had kind of commented on this, but our allocation to non-traditional assets over the past 10 years earned about 14% annualized returns. Public equities earned about 12%, and fixed income earned about 4%. So, diversifying into non-traditionals many years ago, thanks to Alice and other long-term members of the committee, such as Leonard and Fred, this allocation to non-traditionals, including privates many years ago, has done very well for the foundation.
So this is probably a good place for us to change tacks a little bit and highlight something that Kristen touched on a little bit earlier. Over the course of the past several years, we fielded an increasing number of requests and questions about how we view impact investing and investing in ESG or environmental, social, or governance issues. And specifically how we think about the mission alignment of the investment portfolio with the mission of the organization. The board over the past several years has chosen to adopt an equity mandate to really try to align to the needs of the community in terms of how we view some of the racial disparities that have persisted for several of our neighbors. Over the last several months, really over the last several years, there's been work done at the board level. In our most recent board meeting, we adopted an equity charge. Within that, we looked at the investment committee charge. And as Kristen alluded to, we specifically included language to begin exploring how we can do this. Now, for anyone who's in the investment sphere, it sounds super simple to think about. It's actually a pretty complex question and kind of how you look at things and how you kind of balance this debate. As we consider the risks that come from being overexposed to companies that maybe have risks that you're not seeing on the balance sheet, which is really what ESG is trying to capture, the market's been increasingly adopting a broader lens to try to incorporate those risks more holistically. This committee spent a considerable amount of time with staff and the board over the past couple of years, and now we're looking to kind of further that work and continue to learn a little bit more. So Kristen, I'm actually going to toss it back to you because you sit on a number of committees, including the executive committee. Can you walk through a little bit how this charge evolved and really what it means for the foundation and the investment portfolio?
Sure. So I think as most of us know, the events of 2017 significantly changed our community, and for that matter, our nation. Personally, I never thought I'd see the day when white supremacist violence would result in the deaths of 3 people in our community. So, consequently and rightfully, Brennan and her team looked inward following these events. And then in 2018, the foundation formally recognized that it must center its work around equity and promised to make a deep assessment of its own structure and function in terms of equity issues. So since that time, the foundation has continued on its equity journey and has actively sought to weave this awareness across all aspects of the foundation, including in the work of the committees. And this has been formalized in updated committee charges across the organization.
So Fred, the big question on investors' mind is, what does this mean for returns? How does it impact? And can you still achieve outstanding results when adopting these types of frameworks for evaluations within an investment portfolio? How do you think about that?
Yeah, so I'll, it's obviously a big trend in the industry, and I'll maybe frame it in the broader context of ESG, which you may, many of you may have heard about. So environmental, social, and then governance, of which equity is obviously a very big and important part. And I would say, done correctly, I don't think it negatively impacts returns at all. But you have to be careful in the implementation. And, I think 5-10 years ago, it was really more of an exclusionary thing. Like, let's just avoid investing in all these various sectors and areas and, negative screen lists and things like that. And I think that can be limiting, in the sense of generally when you cut off investment opportunities, over time, that could hurt returns. I think an approach that more integrates ESG into the diligence and decision making is more thoughtful and more the right way to do it. And we're definitely seeing more of a trend towards that area for managers and just from the community, investment community generally. I think I'll make up a hypothetical, but just think of Coca-Cola. So maybe in the old days they would have said, well, they use a lot of plastic. They don't, they're not sustainably sourcing their water, and their board governance is, it's a bunch of cronies, friends of the CEO, and it's not a very, diverse and thoughtful board. And so in the old days, that would have just been excluded. And I think now you're seeing a lot more investors are going to these companies and saying, no, let's work with you, be constructive in our engagement, and help you find ways to better source water and improve your board governance in these types of things. And so that's how I think it can be additive to returns. The reality too is that the best companies or have already been aligning themselves in the right manner, really driven in some cases by altruism, but in many just by, commercial instincts. It's what the customers want. Nobody wants their companies polluting the water, having bad governance and, harming society. And so, fortunately, just the general trends, are moving in the right direction. I think one thing that I think is really important in this is in the whole ESG movement is just disclosure. And you're seeing big pushes around disclosure on things like, carbon emissions and, governance decisions of how are these board members even selected. You're seeing more board proxy fights and these types of things. And so companies are increasingly under the gun to, to primarily disclose these things and then, start to deal with them and come up with plans to do so. And I'd say as it relates to CICF, we're still monitoring and exploring the implications, of this and how it, and what is the best path forward. There are some simple things you can do that I think we sort of are somewhat hesitant, where you just maybe do a ESG ETF or some of these things that might use scoring, ranking metrics and this kind of thing. But that can be very challenging and very limiting. And so we want to be a lot more thoughtful about it. And also, as Kristen and others have mentioned, focus as much or more on the equity and the local community dynamics of ESG as on some of the other areas. So we haven't yet formally incorporated any changes, but there are a number of discussions ongoing. And it's obviously a complex issue that we continue to work on.
And I think that highlights this very intentional path that we are walking down. And I think that the board has laid out a path over the last several years in terms of kind of exploring the issue and being very thoughtful before going down a road that maybe we wouldn't have wanted to have gone down had we not given it more consideration. And I think that applies really well here. In terms of the work plan that Kristen mentioned, a lot of the work that we'll be doing over the next year is really thinking through the implications of how we incorporate ESG and how we incorporate this equity work within the investment portfolio. And we fielded a number of questions from investors asking us, can you provide an ESG policy? What are the options? And I know that it must be quite frustrating for those of you that have this desire to invest this way, to see us react more quickly. But hopefully what you are hearing from us is the importance of really coming at this from all perspectives and being as thoughtful as possible in terms of the implications to the investment portfolio. And in that, the engagement with you all in terms of our donors and our stakeholders is incredibly important. So at some point over the next several months, you'll be receiving an extensive survey, I would assume, from Katie Kling and the foundation team, really kind of exploring with you, what are you looking to accomplish? How do you want the investment portfolio to function? And what are the things that are really important to you? And if there are trade-offs, what are the trade-offs that you're willing to make? So hopefully we'll be engaged with everyone, including our investment managers and others in this space, to explore best practices in terms of how we proceed. At this point, we're actually at the point where we're going to turn it over to Jim Beckett to provide an overview for the overall portfolio, and then we can come back to Q&A. I see one on Snowflake, so we can look at that in a minute. But Jim?
All right, thank you. Good morning, all. Happy to be with you today. And can everybody see the screen okay that I'm sharing? Did that come up all right? A thumbs up from anybody would be great. Can you see it? Thank you, Fred. So I thought just a quick introduction. Again, I'm Jim Beckett. I'm the portfolio manager with Wells Fargo Private Bank. I'm based in Roanoke, Virginia. And my job at the end of the day really is to coordinate the vision and direction laid out by all the great people on the investment committee that you've just heard from, with the research and guidance of Wells Fargo and what we think is going on in the markets and the economy to build a portfolio that exceeds the foundation's long-term goals. So I thought I would start our discussion today with a little bit of an economic update and where we see things. And as some of the folks have alluded to, it's been nothing short of fairly spectacular in terms of the rebound that we've seen in a very short period of time from the slowdown and shutdown in early 2020 through where we are today. Just a couple of quick highlights. You see the tailwinds and things there. Fourth quarter GDP increased by over 4%, driven mostly by strong contributions from business investments, consumer spending. We still expect the U.S. is remaining on a strong recovery path, and we've got growth estimates for GDP this year approaching almost 6%, so still a very strong period of time. And obviously our economy is driven largely by consumer confidence and consumption, and those readings are approaching or closing back in on near pre-pandemic levels. So that really kind of encapsulates the positive side of things. There's always give and take, there's always risk and return, and on the not so great side of things from a tailwind perspective, rise in potential coronavirus mutations is still out there and a vast concern. In the first quarter of this year, focus for many has been on inflationary concerns as we open back up. If you're building any kind of deck or addition on your house, I don't have to speak to you about lumber prices and what those look like. And of course, that exacerbates concerns around rising interest rates and what that might mean for bonds and fixed income going forward. And then on top of that, you're looking at markets digesting one of the largest potential tax increases in the last 50 years. Our preliminary estimates suggest that might decrease corporate earnings by somewhere between 5 or 6% in 2022. But it's also worth noting that we still expect those earnings to reach new highs in 2022. So it's our belief that we went into the pandemic on pretty solid footing from an economic perspective. And as we reopen and come back through, we're right back there as well. So kind of where are we today? A couple of charts that just highlight some of the big items that folks have been asking about. We expect low inflation, continued fiscal and monetary support, and really the economy's reopening, as I was alluding to earlier, to really push equities to fresh highs in 2021. In terms of kind of where are we headed, again, the US economy is on track for its strongest growth since the mid-1980s, largely a result of successful vaccine deployment and a huge, underline the word huge, stockpile of household cash from massive government support. We're spending money, which again is a good and bad thing potentially at record levels, but that has significant consequences for asset prices going forward. In terms of economic outlook, you can see there I alluded to the GDP growth, upwards of almost 6% domestically, 6% internationally or globally, and that unemployment rate drifting down towards 5.5%. All of that kind of then leads to expectations of higher interest rates and higher inflationary numbers. And you can see those estimates there, about 2.5% for US CPI, and the 10-year Treasury, kind of the bellwether fixed income benchmark. We look at it ending the year 175 to 2.25. We're around 1.6 today. And of course, when we talk about strong outlook from an economic perspective, that generally translates in terms of better economic expectations coming in the increased forecast for the equity markets. And we're expecting strong S&P 500 earnings growth for this calendar year in 2021, probably somewhere between 25 and 30% of where we were pre-COVID in 2019, 2020 before the shutdown. So again, that's a pretty significant increase in corporate earnings that help continue to support the markets. I wanted to just on these next two slides, just kind of reemphasize that bull markets historically have duration and magnitude that lasts a lot longer than where we find ourselves today. On average, that kind of purple dot there, 5 years or so, give or take 60 months roughly in terms of average, and about 175% upward move. You can see the red dot where we are currently, roughly 13 or so months, and up about 80% roughly in terms of S&P 500 performance. This is a busy slide. I apologize. It's probably a little hard to see in this environment, but essentially what's going on here is the orange bars of the S&P 500 calendar year performance going back from 1980 through last year. And then the diamond, kind of purplish diamonds underneath really represent intra-year pullbacks or declines within the S&P 500. And the point here is that even in really good or great years for the market, it's not at all unusual for pullbacks of somewhere between 5 and 10% that occur with pretty great regularity. I think historically, if you do the math, we average a 10% correction, something like every 11 months. And so as Fred was discussing earlier, long-term oriented patient investors, the real moral here is to stay focused on the investment objectives and don't get too distracted by the noise that we see going on in the markets. The next couple of slides are really just asset allocation, and you can see where we ended in terms of year end. And I should mention that when we're talking about asset allocation, and Alice touched on this a little bit earlier, the investment policy statement is really what drives and outlines the responsibilities and objectives of the portfolio, sets the appropriate asset allocation ranges, obviously, and defines any of the return objectives and benchmarks that we have within the portfolio. And unique to the foundation, the IPS also incorporates kind of a belief statement by which the portfolio really should seek excellence in investment results, provide as part of that excellence risk-adjusted returns over the long term that are outstanding, and fulfill at the same time fiduciary responsibilities for prudent investment management, but do so without sacrificing return by being overly diversified. And that's been, I've been on the team now, my pleasure supporting the foundation for almost 6 years. And that's a message that has been communicated loudly and clearly to me and represents our thinking in terms of what we try to bring to the portfolio in terms of recommendations. And so at year end, we were sitting about 62% in equities, 24% in the alternative non-traditional space with Bluestem, which you've already heard about, 10% in fixed income, and about 3.5% in cash. On a little deeper dive in terms of kind of sub-asset allocation, you can see the vast majority, almost 40%, being in the large cap US and mid cap equity space, with about 6% roughly in small cap, 8%, 8.5% in international equities, and about 7% in the emerging markets area. I should mention, when you talk about a higher conviction portfolio like we've put together for the foundation, there's always in the short run the risk of underperformance or dispersion of returns relative to benchmarks. But the committee has talked through that, understands that risk, and is willing to trade off in the short run, perhaps a period of time where we lag an index or a benchmark momentarily for the much greater chance of long-term success and having a portfolio with high conviction and that's not overly diversified. And then the last topic is really everyone's favorite, I suspect, which is performance. And as a number of the commentators and panelists have already mentioned, last year was an exceptionally strong year for the foundation. So up 28, almost 28.5% for the calendar year versus the benchmark at 15.55%. But really strong performance, outperforming the benchmark in every one of the trailing periods since inception and over the last 1, 3, 5, and 10-year periods. We've outperformed the benchmark in 11 of the last 16 years, almost 70% of the time. And probably even more importantly, portfolios outperformed all 4 years in which we've had negative returns to the benchmark. So downside risk is always something we're trying to pay attention to. They've talked, Fred mentioned that the non-traditional space up almost 70% last year, but the great performance was not limited to just Bluestem. Equities in the portfolio were up over 24%, which beat both the S&P 500, which was up about 18.5% last year, and the All Country World Index, which was up about 16.25% last year. And then lastly, you can see down in the bottom right-hand corner, we've got a preliminary estimate. We're still waiting on some final figures from Bluestem for the first quarter. The foundation portfolio is up about 0.4%, where the benchmark is up about 3% over that first quarter period of time. I'll send it back.
Thank you, Jim. So we appreciate the questions that have already come in over the Q&A function. And if you have any, it's right at the bottom of your screen. You should be able to see it if you want to lob those in. But Fred, I'm actually going to turn this back over to you. And a question has come in about Snowflake within Bluestem. Can you talk a bit about what happened there and specifically what the plans are in terms of the distribution of the stock?
Yeah, so for those that aren't familiar, Snowflake is a company that IPO'd last year. It's a tech company that is involved in cloud database management, for lack of a better explanation. Bluestem is there's really three sort of involved parties here. There's the CACF portfolio, which is invested in Bluestem, the second entity, which is then invested in the underlying manager, which is then invested in Snowflake. So there's a few layers here, but if you do a kind of full look through, the CACF portfolio has about 4% exposure to Snowflake. A quarter of that 4% has already been distributed. So we're holding that in the stock and it's liquid, and we could, sell it, any day in the market. The remainder is still with the underlying manager and has not yet been distributed. There's various lockup provisions and rules and other things around the distribution, but the intent is to certainly distribute that, as soon as possible, and then we'll make the decision on kind of what to do with it. I think there is there's been a sell-off in the tech sector the first quarter, and so a lot of these rapidly growing tech companies have sold off a bit. I think at the highs, sort of post the IPO, we might have been more inclined to to sell, or at least sell a portion. The stocks have come down, and so I think the manager and others view it as now maybe it's a reasonable valuation, it's a more attractive opportunity, and so it somewhat depends upon the timing of the distribution and the valuation at that point. But I think ultimately it'll be a combination of us, selling some for cash, maybe keeping some exposure. It also depends upon the guidance of those in the industry that we talk to that are much more closer to to the company. But this is something that should be, certainly this calendar year in terms of distribution. We don't know the exact timing, but it could be in a matter of a couple of months, or it could be later this year.
Excellent, thank you. I don't see any other questions that have come in just yet, but I'll extend it just in case, but we really appreciate everyone's engagement with us, kind of not only in this particular meeting and your attendance, taking some time out of a Friday morning, but also all of the communication that you have all had with the foundation in terms of expressing your thoughts and concerns, but also your appetites and your interests. It's really quite helpful. In the spirit of that, there is a quick survey that will appear, and I don't know how it will appear, but it's magic, so that's how that works, asking a bit about appetite in terms of ESG integration, and also how we're looking at the local portfolio. Without seeing that there's no additional Q&A, I'd just like to say on behalf of this committee, thank you all so much for your time. Jim, thank you for sharing your thoughts and putting the presentation together. And we really appreciate your dedication to the CACF. So with that, enjoy about 11 minutes of found time and have a lovely weekend, everyone.